Commodities refer to natural resources that fall into the three major classifications of agriculture, energy, and metals. The word commodity means that it is a useful or valuable thing, and commodities is an appropriate term because it has a global market. Commodities are physical, intangible assets. They include metals such as gold, silver, and copper, fuel materials like crude oil and gas, and the soft commodities such as wheat, sugar, coffee, and cocoa beans. Commodities, being useful, are needed by modern societies of different countries. As such, these demands greatly influence the prices and cause them to fluctuate. The commodity market is the center that helps to maintain price stability through forward or futures trading. A forward or futures contract allows a supplier to lock in on the price of the commodity months before they can be delivered to the buyer. The buyer, on the other hand, can already fix the future price for the end consumers. Geographically, most commodities have limited supply production availability. Only certain countries, regions, and companies have economic access to these resources. However, practically all societies have a demand for these materials. This has given birth to a large global market for commodities. This market enables commodities to be efficiently distributed from the most economic sources to where they are needed. In investment lingo, commodities fall under the fifth asset class in terms of conventionality. They stand behind the first four classes, namely cash, fixed interest securities, equities, and property. The commodities sector is quite independent from stock and currency markets, and it has no direct correlation at all. The implication is that in case the equity market plummets, the commodity prices would not necessarily go down with it. Other distinct qualities of commodities are their uniformity and fungibility. Since the commodities are not uniquely identifiable, they are easily interchangeable with their own kind. Gold is gold and crude oil is crude oil, regardless of the country where they are mined. Although there are some differences in their quality, particularly in oil and agricultural products, they are graded and classified. Grading and classifying them in specific types ensures that their characteristics remain tolerably uniform and therefore fungible. This solves the dilemma of having to inspect the whole batch of products. It is precisely because of this non-inspection aspect that the large commodity markets can exist today. Thousands of traders and speculators pin their trust on the integrity of these markets. Gold has been the standard for value for thousands of years. However, gold is back in the spotlight due to the recent performance of precious metals, their viability as investments, and inflationary worries. Institutional and private investors are once again discussing the merits of this investment category. Notwithstanding the sell-offs of the recent past, commodity prices have almost tripled over the last 10 years. This is according to the Index Mundi Commodity Price Index. They should know because much of their successes were derived from this emerging market's development. Commodities, to summarize, can then be described as follows. They are natural resources, they are needed by most nations or regions, they are sourced economically from limited locations, they incur large price fluctuations, they are generally uniform and fungible. That's it for now. On our website you can find more posts as well as savings calculators and other financial tools. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your thoughts, so feel free to share them in the comments below.